Welcome to our chapter on budgeting. Budgets are critically important for any business. Any business who's just going to fly by the seat of their pants, pay whatever bill happens to come in today's mail, not really worry about what's due next week, is really doomed to find themselves in a cash crunch. Um, when we are budgeting, we are looking at the goals that we're hoping to achieve, what it's going to take to execute that goal, and then, or to achieve that goal, I should say, what plans do we need to execute? And then we don't want to, this isn't a set it and forget it. We need to go back and assess periodically how we're doing because we may need to make some adjustments along the way. Uh, In terms of the functions that are implicated with budgeting, it involves planning, directing, I should say, and controlling. Um, when we are dealing with budgeting, there is an element of human behavior that we need to be concerned about. Sometimes we set budgets too tight, we set them too loose, or we set budgets that are in direct conflict with the mission of our company. If we set a budget as too tight or unrealistic, employees are going to be like, well, you know what, we're not going to meet this target anyway, so why bother? And what you really need is employee buy-in to ensure that you hit your targets. So involving employees in the process is a key way to ensure that those targets are achieved. The opposite end of this can also be true in that if you set them too loose or allow too much employee involvement, they may pad that budget a little bit, make the sales targets artificially low so that they don't have to work all that hard and it doesn't take them a whole lot to achieve their quota. So you need to do more than just provide a cushion. You need to provide some oversight into how much slack you're going to allow a budget to have. Lastly, you want to make sure that there isn't a conflict with the goal because you've got employees and managers who may be motivated to achieve bonuses or win sales competitions or whatever it is that you're doing that motivates people into that process. But in the end, what motivates an employee to achieve those goals may not be consistent with a company's goals. So you need to make sure that you are not inadvertently setting up an incentive system that operates in direct conflict with what the company is hoping to achieve. So normally you're going to set up a budget on a fiscal year of a company. Then you're going to break that into, months, quarters, whatever time period seems to make the most sense for the company. Whoops. You're then going to want to budget beyond the end of that 12-month cycle. So as soon as month one, for example, has elapsed, we want to make sure that we've got month one of the next year incorporated into this 12-month budget. So it's essentially going to be a rolling budget. We're not going to wait and get to the end of 12 months to worry about the next 12 months. We're going to worry about 12 months from now every day. And we will continue to go back and revise and make adjustments as the actual results may differ from our budgeted expectations. So this is just kind of a graphic that talks about how you're going to approach this continuous budgeting process. So as in this case, we get to the end of February, that falls off, but then we add next February to the budget cycle so that we can make sure that we are not caught off guard and have not planned sufficiently ahead. So normally there is a budget committee that is responsible for finalizing the budget. Those are going to involve kind of the key people. You're going to have your production manager because, it's one thing for the accountants to decide how much they want to produce. If the production team isn't going to be able to achieve that because of constraints from labor or machinery or whatever it is, that needs to be calculated into that. And then the accounting department will likely be the monitors for whether or not success is achieved. We can look at a budget based on what we spent last year. So we can look at last February, look at the costs that went out, and then we can make adjustments from there. Or we can do what's called zero-based budgeting, which is we can just wipe the slate clean and look at February 12 months from now based on the example we gave, and really force everybody who's got a line item on that budget to make an argument for what needs to be included, not just this is what we had last year and it seemed to work, but to really justify that. And that's a way that you can avoid unnecessary waste in a budget and make sure that there's really a business purpose for all of the items that are in there. A static budget will assume a single activity level. And so we're going to produce 10,000 widgets and our budget is based around that. This is not uncommon, but potentially not the most advantageous way, I should say, to budget, because you may have lots of variation in what actually occurs. And if you've got a static budget, it's pretty rigid. A flexible budget, on the other hand, gives a relevant range that activities may occur in. And it's what it is really is we're looking at a series of static budgets within the greater scope of the budget, but we are allowing for different production levels, perhaps different cost increases or seasonal fluctuations that may differ from one year to the next. So certainly during the pandemic, having flexible budgeting was critical because it's not clear what scenario a business owner might find themselves in a given month. But if they have budgeted for multiple scenarios, hopefully they're not caught off guard and they're prepared for whatever situation they may encounter. With the flexible budget, we're going to look at all relevant activity levels. We're not going to worry about the pie in the sky, but we may want to keep an eye on sort of the doomsday worst case scenario just in case. But if the pie in the sky really isn't going to be realistic, that's probably not going to be included. We're going to look at the fixed and variable components that will need to be woven into that budget. And then we're going to prepare a budget based on the varying activity levels. And so because we've already taken different scenarios into account, often this flexible budget can be more accurate because we've theoretically projected the different scenarios we could encounter. So regardless of the scenario we found ourselves in, hopefully we've got a budget that is built to address that. And I'm going to stop here and go on to the next video to talk about the master budget.